Hello guys, my name is Adam, and today we're going to be talking about the Greeks. To start with, we're going to talk about delta. Delta is simply a measure of how sensitive an option's price is to changes in the stock price. More specifically, it tells us how much an option's price changes when the stock price changes by $1. So in this example, when we're looking at this Visa call, the 140 call here, it says it has a delta of 0.49. What this means is if the stock price goes up or down $1, then this option's price is going to increase or decrease by $49 roughly. All these values are going to be multiplied by 100 just because these options have control of 100 shares. I don't really want to go into more detail than that, but that's just how it is. With calls, delta has to be between 0 and 1. This is because calls prices are positively correlated to stocks prices. If the stock goes up, the call's value goes up. If the stock goes down, the call's value goes down. Puts, on the other hand, the delta has to be between -1 and 0 because they're negatively correlated to stocks prices, seeing as if the value goes down, if the share price goes down, the value of a put will go up. So all in all, delta can only ever be between -1 and 1. Options that are deep in the money, or the further in the money your option is, the closer the delta will be towards 1 or -1. If hypothetically, although theoretically impossible, let's say your call option had a delta of 1. This would mean if the stock price went up $1, then you would get $100. So it becomes very similar to owning 100 shares of the underlying stock or being short 100 shares of the underlying stock if you're really deep in the money on a call or a put. It works out that delta is roughly equated to the percent probability of profit. So here, when you're looking at this 0.49, it's essentially saying there's a 49% chance that this option will at some point before expiration be in the money. We might be thinking delta has to change then, because if in the money options are close to 1 or -1, they can become out of the money. They're not stuck in the money forever. And that is what gamma is for. Gamma tells us how much delta changes given a $1 change in stock price. So in this case, looking at this, what is it, a 140 call? Yeah. Looking at this 140 call, you can see that the gamma is 0.09. This means that if the stock price increases or decreases by $1, this delta is going to increase or decrease by 0.09. And gamma is always highest with at the money options. So if you're at the money, if you have an at the money call, for example, and the stock price goes up, it'll very quickly start moving towards 1 delta. This is because your gamma is really high. But then the gamma will start to drop off as the stock price increases, and there's a diminishing return to how quickly your delta reaches 1. And it's an asymptote towards 1. So it starts going really quick towards 1 and then slows off, kind of tapers off towards the end. If you had the same call option and the stock price started going down, your delta would really quickly start going towards 0 and then it would start tapering off because your gamma would start decreasing. Almost like a bell curve in both directions, I suppose. Now, theta, theta, theta. I think you guys know what theta is. It is time decay. It is what eats at the value of your options as each day goes by. And in fact, that's all it's saying. When you see here this 0.11, that's just saying that every day that passes, you are losing $11 of value from your option. Now, theta does change. This will not stay at $11 forever. And it changes most significantly in the last month of your option's life cycle, I guess. All of a sudden, theta will increase and will start eating away very quickly at your option's premium. And you see here theta is negative because each day that passes, you're losing $11. Now, if you sell an option, theta is going to be positive because you're going to be making money. The person who bought that option from you is sitting on a decaying option, and that premium is going into your pocket. It'll be positive, and it'll work in your favor, which is why selling options or entering credit spreads or that kind of deal tend to have a lot higher probability of success. Theta can be a real bitch, or it can be your best friend. Now, theta is not like calculated at any point in the day, like at a certain point in the day. I mean, it's not like at closing bell, all of a sudden your option drops by $11. Instead, it's kind of just baked into the whole process. It's continuous. The decrease in value of your option happens throughout the trading day, and you can't really pinpoint a moment where you're like, aha, that's where it went down by $11, or even if it went down by $1. It's really difficult to determine when theta has affected your options premium. But at the end of the day, you can reasonably conclude that $11 of your option has decayed off. Next up is Vega, and this pertains to implied volatility. Now, if you don't know what implied volatility is, I'm going to link a video that I made about it up here, so go ahead and click on that if you want to learn more about it. All it is saying is how much your options premium, or the value of your option, is going to change based on a 1% move in implied volatility. In this example, if implied volatility went up by 1% or down by 1%, your option's value would increase or decrease by $8. This trips people up a lot. When they buy options, like they buy a call and the stock price goes up, but they still lose value, that's going to be due to Theta and Vega. And Vega can have a really big impact, especially if there's a sudden drop in implied volatility, such as after earnings, and you're long a put or a call. You might be right in the direction of the stock, but if implied volatility changes like super quick, then you can lose a lot of value in your option, and you can actually lose money on the day. Now, Rho is probably the most boring one and the least talked about one, and it is just how much your options value changes given a plus or minus 1% change in the Treasury bill's risk-free rate, which is a mouthful, and if that's all Greek to you, then don't worry about it. It's not really that important. I actually might do a video on it later in the future, although I'll be probably shooting myself in the foot because no one will watch it. But anyway, I wouldn't worry about that one so much for now. Focus on the other four, and I think you'll be good. If this video helped you understand the Greeks a little better, definitely leave a like and subscribe and hit that little bell next to it so you can be notified of more videos like this. Thank you so much. I'll see you in the next one.